I've got a couple questions for you. How much time do you spend worrying about the performance of your properties and the financial health of your owners? Now, how much time do you spend on the performance and financial health of your own property management business? Go ahead and think about it. I'll wait. Oh, you're still there? Property management companies come in all shapes and sizes, and each with its own set of goals. Maybe you spend more time on your owner's performance than your own, or maybe not. If you've got a 5 and 10 year business plan mapped out, well, you're well on your way. But if you need a little help aligning your goals with some key performance indicators or KPIs, we can help you out. In this video, we'll cover the 11 KPIs every property manager should be tracking to keep their business not only running, but thriving. Let's get started. Revenue growth paints a compelling picture of whether the company is doing well or whether there are areas for improvement. All the other property management KPIs roll up into this one. For instance, if revenue has declined, you can use these KPIs to discover why. Maybe rents haven't kept pace with inflation, or maybe you faced a one-time cost, like moving to a new office or investing in a whole new tech structure. In any event, revenue growth should be at the top of a property manager's list of metrics to measure. Tracking properties won in a year and the money they brought in is great, but those wins are only as good as the losses they offset. Let me explain. Let's say last year you won 3 new properties that together will be bringing in $18,000 in recurring monthly revenue. That's great, right? But what if you lost one big client with 10 properties worth $10,000 in recurring revenue? Those 3 new properties aren't really making as much as you thought they would be, right? You can analyze your new business against churn by creating a simple spreadsheet with the name of your client, the date they signed, the amount charged for services, the date they left, and the reason why. You can also use a property management software solution such as Buildium to create custom reports that will help you analyze wins and losses and plan for growth in the future. For more info, check out the link in the description. Obviously, you want your wins to outweigh your losses, but remember that strategic growth should be your goal. Sheer volume is not the be-all end-all. You need to grow in directions that will benefit your ideal customer. If after pitching a potential client, your business development efforts are unsuccessful, don't be afraid to follow up and ask for feedback. And if you lose a client, follow up to understand their reasons for leaving. Next up, and on a related note, you should also monitor your customer acquisition costs. You can do that by calculating your total sales and marketing budget for the year, then dividing that number by the total number of new units acquired during that time. Calculate the customer acquisition cost per unit to see how you stack up year over year. It may also be helpful for you to look at cohorts or specific groups of leads apart from the entire average, especially if you ran some more pricey marketing campaigns in a given period. Overall, customer acquisition costs will give you insight into how effective your business development techniques are and whether there's room to drive those costs down without missing out on new opportunities. In a strong rental market, particularly in urban areas, occupancy rates can hover around 95%. If your properties are located in a suburban or rural area, however, that rate might be lower. Of course, we're talking about averages across entire regions of the US. It's important for you to know the average occupancy rate in your market and for your portfolio. If you're beating the market average, that's a great selling point when pitching to new prospects. Every property owner wants to know that you can keep their units filled and occupied at a healthy rate. If your occupancy rates are significantly higher than the market average, however, that begs the question, are you charging enough for rent? Property management software with analytics built in, such as Buildium, can help you stay on top of your vacancy and occupancy rates and allow you to compare those rates to those of your peers. Check out the link below. Having a lot of arrears or outstanding debt owed to you on your books can really affect your company's cash flow. This is particularly true if you're paid a percentage of revenue collected as opposed to a flat monthly fee. And remember, owners and prospective owners can learn a lot about the performance of a property management business by monitoring arrears. Look into any situation where payments are consistently 7+ days late. You can see how many residents have paid in full by their due date, as well as the percentage of people who didn't pay on time each month with property management software that offers online payment analytics. Buildium's rent roll feature automatically posts and tracks rent over time and gives you an accurate history of rent changes as well. Again, we've got you covered with a link in the description. On average, rental units turn over every 12 to 24 months in urban markets and 24 to 48 months in suburban or rural areas. Smaller units tend to turn over more frequently as residents grow out of the space. If your turnover rates are higher than average, and again, you should be comparing your rates to the average in your market, there are some key questions you can ask to get to the bottom of it. Are repairs and maintenance overdue? Are you missing rental amenities or services that are standard for your area? Are you charging too much for rent? Are you unresponsive to residents' concerns? And as residents leave, don't be afraid to ask why they've decided to move elsewhere. This is an important property management KPI that many companies overlook. When a unit turns over, do you know how much it will cost to get it in rent-ready condition? Some property managers don't bother calculating the costs associated with turning over a unit, especially if the work is done by their in-house team. Keep track of your rent-ready costs, including labor, to find opportunities to increase efficiency and lower expenses. Each day that passes on an empty unit is money out the window. Oh no! So keeping an eye on how long it takes to lease a unit is critical. The average days to lease should be compared to the market average, usually less than 2 weeks in a hot market. If it seems to be taking a while for the unit to lease, take a look at where and how a unit is advertised. You may also want to evaluate your lead to lease process. Do your listings include virtual tours, for instance? Can prospects apply right from listings using a digital application? Property managers often track the net income generated from leases, but it's important to evaluate other streams of income as well. That could include revenue from convenience fees for e-pay, tenant screening, coin-operated washers and dryers, leasing of parking spaces, on-site community space rentals, fees charged for storage lockers, etc. Rents are just one revenue stream, albeit the most important one. Property managers should consider other ways to increase their cash flow as well. Property management fees usually run anywhere from 8 to 12% of monthly revenue, depending on the level of service you provide. How do you stack up against your competitors? How often are you looking at the competition? What are they charging and for which services? Even if you start out by charging rates on the lower end, don't be afraid to increase prices, especially as you add new services, new technologies, or new tools to improve your owner's overall ROI. On the other hand, you may be putting yourself at a risk of losing customers if you're charging too much or you've discontinued services without lowering rates. If a toilet is leaking, do you rely solely on the repair assessment of your longtime plumber or maintenance team? How often do you really consider whether a repair or replacement is actually needed? If you use vendors, how often do you shop around to compare pricing? Do you conduct market research to understand how much a specific project should cost? If you're planning a big renovation to bring property up in value and quality, what's your break-even timeline? Repairs and maintenance are usually the biggest line item for property management companies. Most property managers will find cost savings to improve the company's revenue if they look critically enough at their R&M expenses. Remember, you can't monitor what you can't measure. Collect data, benchmark your performance against your company's previous years and your competitors, and then make adjustments as needed to improve the overall value of your business. To help you, find a tool that keeps track of the key metrics of your business. Software solutions such as Buildium, for instance, can help you keep tabs on the money coming in and out, vacancy rates, and much more. Our Analytics and Insights Hub, for instance, is a central place in Buildium where you can see past and current views of resident activity, payments data, leasing performance, and even company revenue, accompanied by clear, actionable insights that will help you make better business decisions and impact growth. To learn more, check out the link in the description. And to get more tips to help your business thrive, subscribe to our channel and check out the other videos. Thanks for watching.